Micron has officially hit a $1 trillion market cap for the first time as the stock surges over 19% in a single day. If you take a look at the 1-year chart for this stock, we can see that in about April or March of 2026, the stock was sitting at about $355, and right now it's over $890. This is an insane jump. Usually stock prices do not look like this, so let's go ahead and take a look at the financials to see if this makes sense. Now, if we take a look at the EPS compared to the price, we can go ahead and see that the price is following the EPS. Hence, they're making more sales. Of course, there's going to be more cash flow in the company. But before we take a look at more of these numbers, let's understand what Micron technology actually does. It's pretty simple. They basically have three main products. They have a DRAM, which is a short-term memory that helps apps run fast. Then they have the NAND, which is a long-term memory that helps you store photos, videos, files, etc., etc. And then they have the HBM, which is their more popular super memory that is used for AI. Of course, since there is an AI boom right now, everybody wants an AI to power chatbots like ChatGPT, Gemini, etc., etc. Pretty much they sell these chips to huge companies in the $1 trillion market cap, and of course everybody else, but to especially Nvidia, Apple, Microsoft, and Amazon, that everybody's pretty much in the AI race. Sample picture: a computer needs a brain, which is a GPU. You need fast memory. Micron can make that fast memory along with the long-term memory along with the super memory, so they have a 3 package in one. This helps AI and apps work rather quickly, therefore such a high demand in the company. Now their shares outstanding are pretty much remaining the same. They're not giving you more value as an investor, but who cares if the stock price looks like this, right? And it's going to be the same thing for the revenue. They had a huge jump since January to now May of 2026, and this is because they just build memory chips like we just talked about, and tech companies really do need them. They put the chips into devices where it's a computer, phone, and then that goes directly into the consumers, which is us, that are going to buy a computer or a phone, and that's how they make a lot of money. And to understand some of the advantages of Micron, right, they're very hard to build. It costs billions of dollars to build memory factories. So you need tiny memory chips, you need giant factories to make them, you need advanced technology, advanced sciences to make that, which takes years and years to build it, and you need years and years of experience. So that's one of their main advantages. Advantage number 2, like we just talked about, is going to be the AI need for all these chips. So there's an AI boom. People need, or huge companies need, super fast memory. Micron sells the super fast memory, so Micron makes money. And this is pretty much their business model right here, right? We have Micron at the top. Like we just talked about, they make the chips, and then it goes into phones, computers, AI, cards, cloud servers, etc., etc. Of course, there's going to be a risk, but before we take into a look at that, let's go ahead and see the gross profit. Again, it's growing and following the share price. Operating income is going to be the same thing. And if we take a look at some of their financials, we can go ahead and see that revenue is up 49%. EPS have grown about 984%, which is insane. And their free cash flow is up 1,279%. Now, one thing that is crazy, apart from them having giant factories to build the data centers or having the data centers, is that they have $101 billion in assets with only $29 billion in liabilities. This is huge for a company that has these huge buildings, that has this amount of debt. They still manage to have a lot more assets, almost triple the assets. Now, if we take out other metrics that can give you an idea of how efficient the company is, like the gross margin, like the return on capital employed, like the return on capital invested, we can go ahead and see that these are 35, 37, and 58%. Usually this is a sign that management is doing pretty well in terms of when it comes to how much money per dollar the company actually makes. And of course, there's also a risk, right? Like if the demand for AI falls, they're going to have a lot of inventory. They're not going to sell as much. This is going to hurt the company when they report their earnings. Wall Street's not going to like it. They're going to think the AI boom is over. So therefore, the company might drop in share price. Now, they have a dividend yield of 0.06%, which is a check mark there. I like companies that pay a dividend. Keep in mind that we're going to take a look at the intrinsic value as well. Their buyback yield is nothing crazy, but at least they were buying back some of the shares and then they stopped doing that. But their debt pay down yield is 4.18%. So not only they have 3 times the assets, but they're also trying to get rid of all their debt. Now imagine the company making more sales, having less debt, and then they're going to have a lot more free cash flow, which they're probably going to reinvest somewhere or increase their dividend yield. This is going to be very good for the stock. I'm just wondering how Wall Street is going to think about it, and then see if the stock actually goes past the $1,000 mark. Talking about Wall Street, let's go ahead and see what the rating for MU is. Currently, they have a strong buy of 4.52 out of 5. This consists of 44 total analysts in the last 90 days, 30 strong buys, 9 buys, 4 holds with 1 strong sell. Now, we are going to take a base case scenario look at their intrinsic value, but if you can go ahead and see this historical intrinsic value, which is this gray line right here, once the stock or most of the time of the stock, it was undervalued. As you can see, it was this green line, and then all of a sudden it is considered to be overvalued. Now keep in mind that there's different ways to determine the intrinsic value. Of course, there is a formula, there's a calculation, but it won't work the same for every single company because MU right now is having an insane amount of growth due to what is happening with AI. So you have to ask yourself, do I think that this will be the future? Do I think that this will keep going on? Or do I think this will die down very soon before you make a decision in investing in this company? Now, if we take a look at the base case scenario, we can see that the company is currently overvalued or considered to be overvalued about 49%, giving it a stock price of $457.93. And usually before you buy a stock or invest in a stock, again, this is not financial advice, this is just the theory, you should have at least a margin of safety where there's like 10 or 20%. So if you were to have a margin of safety of 10% below the intrinsic value, which would be this number here, you could be or should be buying this stock around $366 just to be safe. Of course, like I mentioned, this won't work the same for every single stock, and this is not financial advice. But if you enjoyed the video, please consider leaving a like. Let me know in the comments below what you think of the growth of this company, and as always, I'll see you in the next video.